Good afternoon, everyone. Thanks for remaining on the seat and coming back after lunch. I know this is actually the toughest part of the day. Thank you, iFast, for giving me this. Okay, nevertheless, we are in a pretty interesting period of the year. First half of this year, I think most of you should be pretty happy. Market was generally good. And whatever losses that you incur from last year carried forward this year, you should be reduced loss. And if you have taken the brave and under the encouragement of your advisors, you dollar average, most of your holdings will be making money. Maybe for one or two others, unfortunately, it may stay negative for a long, long time. That's partly because the wrong type of risks was being taken. That's the reality of life. All right? But nevertheless, there's always different opportunity. Different things happen every year. And this is where I think for the next half of this year, and especially going into next year, generally I believe there are a lot more opportunities because a lot of policies that were restrictive, which was the whole of last year, has started to turn. And if that is the case, there is room to maneuver. And how do you want to maneuver? This is where you need to talk to iFast and talk to all your investment advisors. That's very, very important. All right? Now, for me, I think it starts with economics. Generally, the world continue to grow. US growth going to slow down this year, we know. From last year, 2.5%, this year, more than 1%. Europe cannot tahan already, cut interest rates. And effectively, a lot of them thought Europe would be in a recession, but they did not. It was a painful, slow negative growth. And if I want to describe how painful it is, you are driving up from KL to Penang at 10 km an hour. No, generally that's what it is. Nothing moves. You have not enough gas, you don't have enough oil to run your economy. But you still need to grow, right? And in China, effectively, it's an engine with 4 pistons, but I think only 2 pistons are working. After running for 30 years, the engine, it needs to be changed. Definitely. The change is externally stimulated as well as domestically. A lot of things have changed. You cannot produce a toothbrush for $1 anymore in China. It'll be $3 now, all right? A lot of them. You need to export the toothbrush to maybe in Africa or even Laos to get the $1 per toothbrush, right? For inflation, I think the latest US data provides some level of comfort. What I think is important is the next data have to be of equal standing. Also not so strong, no need to be negative, but 0 will do. Then perhaps you will give the Fed the encouragement to cut. And I think most likely it will be in October. You notice the European Central Bank just stopped, says, inflation suddenly doesn't behave the way we want to stop. Well, if you look at the way the economy is growing, you think there's inflation? So you ask yourself, who's controlling inflation in the country? All right, that's something you ask. All right. So generally, I think the worst of inflation expectations are over. People will be looking to cut interest rates, and central banks have cut interest rates. The first is actually Canada. And a lot ask, you ask, really? Canada? Then you ask me, so what's so important about Canada? But Canada, whether you like it or not, is actually a subset of US. They never do anything ahead of the Federal Reserve. But they are ahead of Federal Reserve. All right? So effectively telling you that they are feeling even more pain than the European countries. They have no choice. All right? Then the rest, China does not have inflation. All right? So they can cut interest rates. And the question is, which particular interest rates they need to cut? Most of it, most likely, will be the 5-year interest rates, which is linked on to the determination of mortgage rate in China. All right? So the question is, by October onwards, if US to cut interest rates, because a lot of central banks look at US one, US don't cut, I also don't cut. US cut, I follow. So there is a period from 4th quarter of this year into the 1st quarter of this year whereby multiple central banks will cut interest rates. And the question you ask yourself is, how will the whole global capital market will behave when every central bank, every other week, the central bank cutting interest rates for almost like 6 months in a row? market sentiment should be healthy lah. It's difficult to be negative when everybody cut interest rates. And growth is not in negative territory. So the question to ask, very important now, is you want to jump in when everybody feel positive, or you want to come in now when everybody's still feeling rather uncertain? That's a reality, right? This is where I think you need to think of your existing portfolio. If you're already making money, then ask yourself, if everybody cut interest rates, then some people, some part of the market will feel they are willing to take more risks. The question is, are you targeting that group? Or do you think that you want to drive just a Camry is fine? But you want to get into a Porsche or Maserati, please get the right type of product. A simple thing. But then you must remember whether you know how to drive a fast car or not. Driving at 120 miles per km an hour and 200 km an hour is a totally different type of thing. Whether you're a type of, you just go, totally different, okay? So this is where I think your risk profiling, and as you have not learned after the last 2 years, there's something wrong. The next thing is, if US cut interest rates, the dollar most likely will soften a little bit. By how much, I can't tell. I thought initially it should soften a lot, but unfortunately this year there's still elements of volatility, and most of it come from politics rather from economics, because most of the economic issues you are fully aware of. Growth, inflation, blah, 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 right? But politics, who knows? It may be an 18-year-old become president in US. Then be like, oops, does that mean he says party all the night? Yeah, sorry, I shouldn't say that. But this is something that whereby it's quite difficult to quantify. And because of the element of uncertainty, and US dollar is still a safe haven, people will continue to buy US dollar. But as interest rates are cut in US, people say, oh, you're not giving me the return I want. I need to go elsewhere to look for better return. US dollar will naturally soften somewhat. If you notice, US ringgit have not bounced back up. Stay at 466, 467 for the last few days. Despite a lot. China last few days dropped like a rock because they always say we are linked closely to them. It didn't happen. So you have to think of the fact that the global trend has started to happen. All right? So this is where there are two things happening, right? Or three things happening. One, cut interest rates, positive sentiment for equities and bonds. US dollar weaken, it goes elsewhere and around the world. How do you want to capture that? And it's especially the fact you have to recognize the fact that for the last 18 months, developed countries has outperformed emerging markets. The only emerging market or Asian market that has actually performed very well is India. This year is Malaysia and Vietnam. Japan still there, but Japan is a developed market, so very different. So the question to ask is, would the developed market continue to give you the type of returns? Or do you think that because money flow out of US dollar, then where we want to go? And then you also must ask yourself, within US, the big caps, all the well-known names have run, but last 4 days, you notice the Russell 2,000-3,000 have run. It's considered small mid-cap in US. But you must remember, small mid-cap in US is large cap here in Asia. And humongous cap in Malaysia. So this you need to think of it that way. All right. So you have different opportunities. Does that mean there's no opportunity in US? But because the market in US is so big, the diversity within US will still be part of the money in US. But it may mean your large cap may not perform that well. You still get some upside, but maybe not so attractive. All right. So you need to think of that. Okay. Please talk to your advisors, talk to IFAS. There are many, many things that offer. So you can please think of that. Quickly, this is from the World Bank. As you can see, US growth is slowing. Asia continues to roar on. I think the China's growth, you need to revise upward. After the third plenum, they tell you at no question we will go and meet the 5% objective. This is only the third time in 20 over years they say that. First was 1998, the second time was in 2008. And now it's not even a global recession. They say the same thing as in 98 and 08. All right. Effectively, politically, they are moving everything possible, positioning everything possible to support growth. The previous gentleman has talked about a lot of China, so I'll just tell you, effectively, there will be a lot of money going into the Chinese market. And you know, in the economy, when there's a lot of money, the part of the money will go somewhere else. All right, that includes bonds and equities. You have to ask yourself, how do you want to position yourself when that happens? All right? That's all I can say, right? This is what you call a soft landing US. Not too much of that. The numbers for second quarter, third, fourth quarter, and until fourth quarter may be lower, but it's still fine. This is what we think the agak-agak, what we think this number will be. This is totally acceptable. It's only when you start to panic when it's negative. But that is okay. Negative means you need to cut more interest rates. All right? Cut even more. Definitely inflation not an issue already. All right? Then this is the labor market start to turn. Also partly because it's a reversal of after the COVID-19 issues. So starting to normalize. So back to maybe whatever level there is. Then in Europe, like I mentioned, economy not going anywhere. Inflation is actually moving towards the direction they like. Unemployment is huge. Driving 10 km from KL to Penang. Sorry, it take I don't know how long. So they cut interest rates. Then in Japan, totally different. The only country that talk about they want to raise interest rates. After 30 years of having no inflation, they suddenly realize that they have some form of inflation, which is good. It's a total change. Provides different opportunity. And you look at the so-called corporate price expectation, and even their bond yield have moved from 0 to 2-3%. So effectively, they are abandoned what you call yield curve control. All right? In fact, so things are changing in Japan. A lot of different opportunities, but of course, risk will there be there. But what it means is there are things to look at. They have a lot of good corporates that are doing a lot of changes. You think of how you want to participate as well. All right? Then you have China. Second quarter numbers is below par, so-called. Then you have the third plenum. Unfortunately, the plenum is a political meeting. It's not like NPC whereby it's policies, economics. But they have made sufficient. Like I mentioned earlier, we will support growth in the short term. Effectively, this is only said in 98 and 08. That tells you there will be a lot of money going into the market over the next 12 to 18 months in China. When there is a lot of market in the economy, usually part of it will go to one part of the market and it misbehave. And you will see that how it happens, all right? So to think of that, and this is something I mentioned earlier, when everybody cut interest rates, not only in developed countries, those in Asia, including Singapore and Hong Kong, whereby they are pegged 1-to-1 to the US dollar, they will also need to adjust their currencies. The Sing dollar may weaken somewhat, by how much? I don't know, all right? Up to you all, right? But you think of how that is being played, all right? So that's why I mentioned for fourth quarter this year, first quarter next year, every month, every 2-3 weeks, I cut interest rate. Somebody cut interest rate. Somebody cut interest rates. Sentiment sure very, very fluffy one. But please be careful of the fluffiness. You step onto it, you drop below. So just be careful how you take risks. All right? So effectively, when it's fluffy, partly fluffy, you want to sell to the fluffiness. Please do not step into that. All right? Of course, the other thing is, when US dollar start to weaken, it's generally when money flows to the rest of the world. You see how the dollar index and the Asia ex-Japan index perform is negative. And this relationship has gone back many, many years. So to think of how do you want to play on this as well. All right, what type of asset class you can in. One more thing I need to reiterate here. End of last year, everybody thought that a lot of interest rate cut will happen this year. But that did not happen. Most of it will only happen next year now. And what it means is, if you remember last year, the bond market performed. This year, market suddenly didn't perform very well because higher for longer argument came in. But then next year is when you have a lot of cuts. So please do not throw away or lighten up on your bond portfolio. Still going to make money. But you ask yourself, what type of bonds in the whole? Because now it's the developed countries cutting interest rates. So whether you want to be closer to the developed countries' bonds market or not, you think of it that way. All right? Last, I think we still like Asia. Growth is there. No inflation. Current account, unemployment generally is okay. So effectively, on the big picture basis, we look pretty nice. All right? And you look at it, until June 2023, developed countries outperform everybody. All right? Nasdaq especially. Only Malaysia, India, Japan doesn't count. Structural change. we are all the rest the same. So it's telling you, if you have already make money in developed countries, can it sustain the performance? It's a very important question to ask. You may still like technology because it's going to be part of our life. Eventually, my spectacles will be my Bluetooth product. I can answer phone and watch movie maybe 5 years down the road. But that's still 5 years down the road. In between, there are opportunities. Please do not neglect what there is. All right? So to think of Asia, to think of Malaysia, right? Because whether you like it or not, we are actually one of the best performing markets now in Asia. I would say things have changed a lot, but at the margin, things have changed a bit. Foreigners willing to come in and buy Malaysian assets, not just stocks. Yeah, a company who came in and say, I want to take over GHL. Somebody says, I want to take over your Malaysian airport. Last 12 years, nobody even think of Malaysia at all. Out there, you start out there. Really? Oh, never mind. I go Singapore or go Thailand or Vietnam. All right? So for the first time, there is willingness to put money on the ground. Stock market doesn't count one. You can come in today and go out T+7, you can go out already. All right? As basic as that. This is coming in here, put some money. So it's a very different proposition. And you look at how earnings are, revision, Asia looks very good, coming up very fast, recovering very fast. And you look at it, the green line, it's Malaysia. Looks beautiful. Better than the rest of the region. All right? Just think of this number. Yeah, now suddenly the data center of the world, right? Everybody loves us. Some statistics says we are building 40 now, 40 more coming, and another 40 coming. So somebody tell me in terms of electricity consumed, this year will be 25 megawatt, next year will be 80 megawatt or something like that. Can you imagine how much the Naga make? And eventually, who will be all supporting the data center? What are the industries coming in? Although the one data center doesn't hire a lot of people, it's not a labor-intensive thing. 20% will count more than enough for data center. All right. So you think of different way the economy is being impacted positively. All right. And of course, the China plus one thing, the logistics center, manufacturing center is all happening around ASEAN. All right. And Malaysia as well. So this diversity is very important, partly to mitigate the risk. So to seriously consider what other products other than just Asia or Malaysia or ASEAN. All right. This is just valuation. It moves, depend on whether you're positive or not positive on how you want to revise the number. But generally, Asia is still attractive. And you look at it in terms of Asia, which particular sector have the best earnings? Technology. And technology companies are mostly focused in Taiwan, Korea, and part of China. Right? The rest is spread across everybody else. So that tells you what will also drive the market to some extent. And China, not NPC, that includes the third plenum, right? I will reiterate that other than the special long-term treasury bonds I am going all out to support short-term growth, which came out 3 days ago. And yeah, more and more money gathered by the government and push it out in the direction they want, it has to take effect one way or another. All right? So you have to consider the possibilities as well. All right? Now, this, I think, captures China's dilemma best. This is how much deposits the banking system collects every year. New deposits. Before the COVID, 5 trillion over renminbi, new deposits every year. Then COVID, you can't go anywhere. You don't spend money. All right? You only do Mai. They'll send it to you. All right? So it jump up. But reopen, they save even more money. Partly because nobody buy property anymore. Other than not spending money, they are not buying property anymore. But then you must think of the fact that once things stabilize within China, and even we assume going forward, it will be 10 trillion net savings. The amount of net savings that will flow out into the market to support the economy, how powerful will that be? You think of it that way. Money other. It's a matter of suddenly they step on the accelerator, they are accelerating from 0 to 100 in 10 seconds or 0 to 100 in 2 minutes. So this is how you think of it that way. But the issues China's face, unfortunately, is long-term structure, lot of confidence loss, manufacturing sector going through a lot of changes. It could take as long as 10 years before everything is being resolved in within China. And after that, there'll be new problems as well. All right. But nevertheless, what it means for me, China's risk premium will be higher going forward. Higher risk premium means higher volatility, lower valuation. But that's not mean make China not investable. It's still, China have lots of opportunities, but you need to be aware of the volatility and the higher risk premium. And market will no longer rally that much because valuation will be capped. If previously people say China can go 28 times PE, I think going forward, people may say at best I pay 18 times PE for China at the big. Now it's 13 times maybe. So the upside is also limited. So you also ask yourself, how do you want to reinvigorate your portfolios if you have been a great supporter of China for the last few years? This is where you need to think seriously how you want to reallocate all this and to recover and make money from some other part of the world, some other part of the asset classes. You see? At the start, I told you there's so much free money, right? Deposits. The bond market in China have rallied for government bond because all the banks got so much deposits and they cannot lend it out, but they have to pay deposit rates. They need something to cover the deposit rates. You buy a government bond, but already government bond yield is only 2%. Doesn't cover deposit rate anymore. If the money stabilize, come out of it, the money has to go somewhere else. Then you ask yourself, will you go back to the bank or go to the stock market? That's the next stop if things stabilize. All right? And we talk a little bit about ASEAN, a very unfortunate region. In the 90s, when I first started work, we are called the tigers. Then 98 happened, we became cats. But every year, people still put money into ASEAN, invest in ASEAN. Last 3 years, because of the issues with tariffs by China, they're putting more and more things into ASEAN. Hopefully, eventually, we become pumas or cougars. No need tigers. But that is good enough. That will give you a very different perspective to how the economic growth will look like in ASEAN, especially for us in Malaysia as well. All right? You can see all these names. We all know who they are. Of course, after what happened to Microsoft, I don't know lately, yesterday, right? So last few days, right? So you think of it that way. But nevertheless, what it tells you is you shouldn't let somebody control too much things. As basic as that. Everybody must have a chance to make money. All right? And also, anything in ASEAN in the short term is the recovery in tourism. Because you talk about FDI, everybody come here, but an FDI takes 4 years to get it out. You build a factory, 18 months. You feed the factory, another 8-9 months. You test run the factory to make sure products is fine. Boom, it's 4 years already. In between is when recovery of tourism. Very, very important. Cash flow to the economy. All the SMEs, you think the economy become very important, right? In conclusions, there still be volatility, different source. Most of it may come from politics. Inflation is almost there. All right. Most important thing is interest rate pivot and dollar weakness. You want to start positioning for it now, or only when you think that everybody like, wow, everybody cutting, central banks cutting, you say, oh, then only I want to jump in. Then you ask yourself whether you are dollar averaging down, get a better average, or you are averaging up. So this is a question that you ask yourself, whether tactically or strategically you are doing it correctly or not. All right. And final summary, developed markets, we are overweight, but the overweight has changed a lot. We used to overweight US by 400 basis points. It's only now 100. We used to underweight Europe by 400 basis points, but it's only underweight 1 basis point, 100 basis point. Japan continue to overweight. We add a little bit more. We still like ASEAN, Asia. Constructive on China here means a bit tactical. We like ASEAN, we like Malaysia, we like Malaysian bonds, and we eventually will be positive on global bonds as well once interest rates start prospectively. I'm sure if I present in the next meeting, next month, you should be a positive already. Okay. Thank you very much, everyone. Thanks for your attention.